Periods of low volatility are always followed by periods of increased volatility. Andrew and I have been writing for the month of January that our short and intermediate term models targeted early to mid-February as the first real point of downside volatility. And there's a 3-session time variance in there, so the market started down 3 days before February 1st. So the decline came as no surprise. I would say the magnitude did surprise us.
More to come?
You know, typically what you get here, Bill, is you get a climax selling low, which is what I think we got, and then you get turning Tuesday. This is what happened in the 1987 Monday crash, and again in the 1989 Monday crash. You get a Tuesday turn, the market rallies for a day, day and a half, maybe as much as 3 days, and then if it's picture perfect, it comes back down and tests the recent reaction low, and you get a double bottom, and I agree with Carl Icahn. I still think we're in a secular bull market. And I think that, you know, you're going to have a chance to buy stocks again.
Yeah, I mean, that is the way the playbook should go. Jeff, I wonder if you actually think there's any relevance to the overnight low in the futures. I mean, we've been so all over the map in terms of the way that things have been whipped around. Is that something that we're going to have to keep an eye on in terms of deciding when we've tested it?
Well, the overnight trading is thinner than the during the session trading. So the E-mini S&P 500 futures were down over 12 handles overnight last night, and that's what gave you this whoosh to the downside here this morning. But it looks like a picture-perfect recovery so far, but I don't think it sticks. I think it comes back down, we get a double bottom, and then you're off to the races again.
Jeff, what do you think about interest rates? Higher rates better for the rally you're talking about than the rebound? Lower interest rates, you know, what's going on there?
I just spoke at a lunch at Riviera Country Club here in Miami, and the ex-head of the Federal Reserve down here, I talked to Juan for a pretty good while, and we are both of the opinion that interest rates are going to gradually, and I mean very gradually, edge higher. But this is what's supposed to happen as the economy strengthens.
All right, I've just been told, Art Cash had just told us the market on close orders are $2 billion to sell, but as they put it, nobody on the floor believes that for 1 second here. We have come off the highs. We were up 600 points a little while ago, but now up 498, but we're holding on to most of these gains right now.
And Jeff, just go back to the point you're making about interest rates there. Washington policy and Fed reactions here, what are you looking for at all for, you know, after the last couple of sessions that we've seen?
I think you're going to see interest rates, as I said, go up, but go up very slowly. I think you're going to see monetary policy normalize. I think the economy, as I said before, is stronger than a garlic milkshake. And you saw the Federal Reserve of Atlanta come out, and they keep upping their GDP estimate for this year.
Jeff, you don't think that let's just say the Atlanta Fed GDP, which printed over 5% on the early estimate, is anywhere in the ballpark? Was the market not kind of having a little bit of a panic in advance of the possibility of some kind of an overheat? And would that exacerbate it? I guess the question is, how good is too good?
I would tell you that the market was set up to go down, and you can pick your reason for why it went down. You the FISA memo, the NAFTA stuff, the talks have stalled, back up in interest rates, but earnings keep going up. I mean, before the tax cuts, the corporate tax cuts, Standard & Poor's was at 143 for this year. S&P earnings are now up to like 154 and change, and UBS a week or two ago put out a number of 157. So I think earnings are still going to go up from here, and we're trading now at 16.9 times this year's estimate.
Jeff, what are you a buyer of here?
I still like financials. I think they are cheap vis-a-vis the overall stock market. I still like technology, and I like industrials. I would stay away from the defensive names, consumer staples, utilities, telecommunications, names like that.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.